Hello, good afternoon, everyone. Good afternoon and welcome to the roundtable of the conference, which touches upon a very relevant subject, central bank digital currencies. That is the issuance of a new central bank liability in digital format and accessible to all users. The interest around this digital version of central bank money is increasing exponentially across the globe. And according, for example, to the BIS, almost 90% of the central banks are exploring the benefits and drawbacks of issuing CBDCs. And in the last couple of years, we have seen a few of them either launching, pilot, or actually going live. While being a worldwide phenomenon, there is no doubt that the specific circumstances of each jurisdiction have a bearing on the analysis of its pros and cons. Nevertheless, when confronted with this topic, one question that inevitably arises in all cases is how a CBDC may impact the stability of the financial system. This is precisely the topic chosen for this relevant panel. Just to introduce the discussion, let me mention three complementary perspectives from which the issue may be considered. First of all, while there is a need to assess how a CBDC may impact the financial stability, I also see the need to ask ourselves about how the absence of a CBDC could affect financial stability. In this context, it is important to bear in mind the recent developments in finance linked to the new technological advances and the digitalization. In other words, in my opinion, the status quo is unlikely to be an option. The second one relates to CBDCs in normal times. When addressing the issue of CBDC and financial stability, probably the first thing that comes to our minds is disintermediation. Indeed, a significant transfer of deposits and payments from commercial bank money to CBDCs could be a major disruption of the banking system and, as a result, a challenge to financial stability, or at least as we know it. Central banks need to take this into account when considering the design of a CBDC and find ways to strike a balance between the roles of the central banks and, of course, both the traditional and the new financial intermediaries. This brings me to the issue of how to design the features of a CBDC, including elements like limits to the holdings, or specific remuneration policies, or other kind of specific functionalities. And finally, the third perspective I wanted to touch upon was the functioning of CBDCs in crisis times. We all know that banks are subject to a significant amount of regulatory and supervisory, let's call it burden, which is clearly justified by the risks of depositors and to the risk to financial stability. So in crisis times, CBDCs offer to citizens and to corporates an option to move their deposits to a safer asset. So the question is, would then a CBDC exacerbate bank runs? Can design features cater for the risk without endangering the success of a CBDC in normal times? I'm sure that we will benefit from today's roundtable to answer to many of these questions, and of course, also we will benefit from a very fruitful exchange of views and experiences. And without any further delay, let me introduce our dear and reputed panelists. First of all, Dr. Markus Brunnermeier. Hi, hello. Good morning, I guess. Professor at Princeton University and advisor to many institutions, very high-ranked institutions. Monsieur Jean-Pierre Landau, currently associated professor and researcher at Sciences Po, and Sir Jon Cunliffe, Deputy Governor for Financial Stability, Bank of England. And without any further delay, please, Dr. Brunnermeier, you have the floor.
Thanks a lot, Deputy Governor, for giving me the opportunity to present my thoughts here, and it's a pleasure to be on this great panel at this great conference. And thanks for letting me to present online virtually. So I would like to talk a little bit about CBDC, and as you pointed out, actually we should not see CBDC from the perspective of the current financial system. We should actually put ourselves into the future, how the future will look like, and what role will CBDC play in this future world. So let me just highlight certain elements of the new world. Of course, there will be much more currency competition among various currencies, because the switching costs will be very much reduced. And right now, you're very familiar with the euro, and it's very hard to think of, different currencies or constantly in your mind recalculate it. But in the future, we will probably go with augmented reality glasses into shops, and we can just calculate prices in our favorite currency. So the price stickiness aspects and many other aspects, the familiarity of certain prices in certain currencies will actually be very, very different. So it's a little bit like, right now we speak different languages. Once we have a language translation software which translates everything automatically, the binding forces which shall bind us together to a particular currencies will be much weaker. And we probably have several currencies in our digital wallets, and we have also new digital currency areas emerging at that time. And that might actually limit monetary sovereignty in the policy space central banks have. And to some people might say, like Hayek saying, it limits the possibility of having high inflation. So it might be a good thing. But that's essentially where we have to put and see ourselves, what role will CBDC play in this new world, and what role would it play, as you said, in the absence of CBDCs? What role would central banks have? And the first thing which comes up is the financial stability issue, and that's the focus of this panel and also the whole conference. So will CBDC make bank runs more likely? And I would argue it's not necessarily the case. It depends how one handles it and one regulates it. Because if you don't have bank runs and you can't run into CBDCs, people will run into something else. They might run into other digital currencies. And that might be a much bigger concern than running into CBDCs. And let me illustrate this in a simple example. So the first thing I would like to make is that the first comment I would like to make is that CBDC, the impact on banking, it might be neutral if certain policies are put into place. So that depends, how competitive are the CBDCs with respect to deposit taking, is this desirable? And the first thing is relies on some work I did with Dirk Knöppelt, essentially saying if there's a run into CBDCs, or if there's a lot of deposits moving into CBDCs, the central bank can always channel the funds back to the private banking sector, and they can channel it back to the same conditions as the private sector was doing as well. So that's essentially a neutrality result. So you can always, if you really want to, you keep it more neutral. Of course, you might say, then if the central bank is exposed to some of the default risk by the bank, and it's not the private households anymore. But the argument might be, we have anyway deposit insurance to some degree, so this government is involved in any way. And the other argument is that bank supervisors probably have superior information to decide which bank is solvent, which bank is illiquid, but then individual households have. So in this sense, it might, not make a big thing. And as I mentioned before, if you don't have CBDCs, you might not have bank runs. You might have a bank run and people then running into some other bank, or at worst, they might run into some other currencies, and then you lose control much more quickly than having somebody or the public running into your own central bank, and then you can channel the funds back. I think that's an important element to take into account when being worried about bank runs becoming more likely. And if there's the right response, is it understood and is it well communicated, it's not clear that bank runs are more likely, because people know if there were a bank run, then the central bank would channel it back into the private banks, so they won't run in the first place. So that's all about communicating clearly what the reaction function would be when this thing would occur. Now, then you might argue, what is really CBDC, how it is impacting the private banks if you don't funnel the deposits back at the same interest rate, the deposits are currently getting. What we have at the moment is that the private banking business enjoys some market power on the deposit side. Okay, so in particular, in high interest rate environments, the banking sector has huge market power and gets very cheap funding opportunities. Once we go to negative or zero interest rate, this interest rate advantage is not so big, and that's actually a big advantage. So the question is a little bit, will CBDCs unbundle essentially the loan provisioning from deposit taking? So is this CBDC impact on the liability side, you take some profit opportunities away from the private banking sector? Is this desirable or is it not desirable? And that's essentially the next question I would like to address. It's a little bit related to narrow banking. Do you want to allow narrow banking, which also will take the deposit profit side from the private banks away? And do you want to give some monopoly rents to the banking sector for some reasons? And then we have to talk about, is it rational, is it desirable from a social perspective to give banks this monopoly rents and or this market power rents from deposit taking? And there are several rationales for that. So if you're a narrow banking favorite, but then actually you would not say there is any rationale for that. Let's make the deposit business also competitive, and this will benefit the consumers who typically are taking advantage by this market power of the private banks. Now, what are these rationales between the two aspects? And one is that you have certain synergies between deposit taking and loan provision. So essentially, by giving banks some market power on the deposit side, they can grant more loans to the real economy, and you would like to subsidize that. And the reason for that is, that goes back to a paper by Anil Kashyap, Stein, and Ragurajan. Essentially, the economies of scale of liquidity and cash management. So what you face as a bank, you might always face certain deposit withdrawals, so you have to hold a certain amount of cash. That's on the liability side, but also on the asset side, you also have certain withdrawals because people draw on credit lines. So you have both the potential deposit withdrawals and potential drawing on the credit lines, and the correlation might not be perfect. And hence, it makes sense to have both the synergies, deposit taking and loan provision, particular credit lines, under the same roof. And this way, if you now introduce a central bank which has a superior cash management technology because it can just elastically generate deposits, so private banks cannot compete with the central bank, you might actually destroy the synergies. You take one element away from the synergies, and that's one argument in favor of us subsidizing essentially private banks through a deposit-taking channel. A second argument goes through franchise values for banks. That's essentially saying you want to give the banks some franchise value, otherwise the limited liability will lead to excessive risk-taking and there's moral hazard problem. But if they have a franchise value, if they're expecting the future to generate some market power rents, then they will be very careful not to lose their franchise, and that makes them less willing to take risk and might not be willing to take excessive risk. So you would like to give them this franchise value in order to limit their risk taking. The second part of the second rationale, there are several under certain reasonings under the second rationale. The second sub-reasoning essentially is banks, they will be regulated, and that's like a stick that's not very nice to be regulated, so you have to create them an incentive to be in the regulatory perimeter. And you have to give them, on top of the stick, also a carrot. And the carrot you give them is essentially, you give them some market power in the deposit market. And that's the second argument. The third argument is that, there might be some financial frictions where banks have some superior technology, they have some superior technology to diversify idiosyncratic risk, and they can only take advantage of this superior technology if there's a certain amount of net worth, a certain amount of franchise values. There are many economic models along these lines. And for that reason, you give them the market power in order to build up some net worth, some franchise value, which helps them to overcome that. And the fourth argument essentially is that the government would like to, has certain pet projects and would like to have some cheap funding through the banks, and the banks will not be willing to provide this cheap funding, but if they get in return some benefits from having some market power in the deposit market, that they can be convinced to provide some cheap funding, whatever it is. It might be like in the US in the 70s, to promote home ownership or whatever it is the government would like to promote. It can get cheaper funding through the banks by compensating the banks for providing this cheaper funding with a market power and deposit market. So all of these arguments, they can be present, but the question is, why should the transfer be via monopoly rents on deposit taking? So from a theoretical and abstract perspective, there might be some reasonings to provide these benefits to banks in order to incentivize them correctly, to give them the chance to be part of the regulatory perimeter. But it's not clear why you want to give them monopoly rents on deposit taking. Why is this the best way to give them the advantage? In particular, because the advantage is bigger in boom times and less in recession times, because then the interest rate is closer to zero lower bound. So the information, the rents, the monopoly rents are much bigger. The interest rate differential between the deposit rate and the policy rate is much bigger in times of booms rather than in recessions. It goes actually in the opposite way. You would like to give some more monopoly rents when the banks are undercapitalized. So that's the second group of rationales why you would like to give subsidized deposit taking in order to have loan. What CBDC does, it does to some extent, it unbundles these two things, and it might make it more difficult. And a third rationale, I put it out there, which some people might not find so convincing, is that runs are a disciplinary device for loan funding. So you would like to have the banks giving loans and being exposed to runs at the same time. So you would like to have the institution which grants loans also to issue short-term debt. But it's not clear why it has to issue deposits or money and be subsidized from doing that. It could be just having some maturity mismatch. And that's the Kalamiris Khan, Diamond Rajan story, that runs a disciplinary device. And hence, there should be maturity mismatch in the entity which grants the loans. And you would like to subsidize this way. So that's how CBDCs might undermine certain elements. And there might be some elements where you think, oh, actually there's a rationale for this low deposit funding. And the question is, do you want to keep it or not, or is there a better way to arrange it? Now, there's also a rationale with regard to platforms. So essentially, CBDC will also impact platforms. And that goes back to some recent work I'm doing with Jonathan Payne here at Princeton. There are digital platforms which have a different matching technology, finding buyers and sellers and bringing them together. And they're also digital tokens. So there's an interaction between the payment technology and the matching technology. Essentially what you have, if you have a platform and you issue your own token, you can actually then, you sell something in exchange of this token, and then on the same platform you can then spend the token. In particular, if you have to swap the token to a new token or to some CBDC, if there's a fee attached to that, you would like to swap it, you would like to use the same token. And because you others know they will use the token, you also will try to sell against this token. So there's some economies of scale there, some network externalities there, and there's some lock-in effect. And essentially, when you come in the place and everybody uses a particular token, you would also like to have the token. So you're essentially born in some digital currency area. Now, if a new platform would come along and would issue a different token, then actually it would be very hard to establish yourself compared to the existing incumbent platform. So that's why the incumbent platform can extract rents from in form of fees, or can have a high inflation scenario on its existing incumbent platform. And then the question is, how should we regulate this competition between potential platforms, or how should we see the competition between the platform and CBDC? And how should this be regulated, and how should this be seen? What role should CBDC play on this? So one approach is to say there should be, regulate the competition among the platforms. There should be enforced currency interoperability. So all tokens which are used in one platform they can be exchanged without any fee to another platform, so you enforce currency interoperability. Another way to do that is to introduce CBDC and say CBDC should be the legal tender. So the private platform is obliged to accept CBDC without any charging extra fee, without granting some discount on the private token. So there's always CBDC is very competitive. So the advantage of this is that, you know, if you have this CBDC as legal tender, you will destroy any locking effect. But CBDC as legal tender or destroys all the smart contracts. So the advantage on this platform is that there are certain smart contracts which allow people to borrow against future sales and revenues. Okay, there's future income, you can borrow against that. And the digital platform can enforce these repayments because it can say, if you don't pay back, I will exclude you from the platform. And that's a powerful enforcement mechanism. And that's why when you look at Alipay and all these things, they have a very low default probability because they can exclude people from their platform. And if you have CBDC as legal tender, you destroy these smart contracts. So you can have many more smart contracts and complicated mechanisms which can be, you know, designed for the particular digital platform, like Ethereum is doing quite a lot. And if you can always, as an outside option, have CBDC as legal tender, you destroy essentially the enforcement of many smart contracts on the private platforms. So in general, there are two ways forward. You might limit the effectiveness of CBDCs, don't make them so smart, don't make them so legal tender. The other one is you also make CBDCs smart. Okay, it's like this programmable money element to it. So these are the two ways you can go forward. I have not formed my mind about that. But if you go for CBDC as legal tender in a non-smart way, you also make a choice in the digital market structure. So we can think of two market structures. One is an intermediary market structure like Amazon. When you buy something from Amazon, you always buy it from Amazon directly. You don't buy it from the actual producer. So there's always some person in between, or there's always Amazon in between as intermediary. Or you can have B2C or C2C, a little bit like eBay, where the platform is just matching buyers and sellers in a digital way. If you go for a legal tender CBDC strategy, the second form will die out. It won't be able to have its own digital currency and be active in this space. And you will actually, and it will not be able to offer the smart aspects to it. So we will actually move to a setting which is much more like Amazon as intermediaries, because the intermediaries can still implement and enforce the smart contracts, even in the presence of non-smart CBDC as legal tender. So what's important as a main message I would like to get across is that it's really market structure impacts. The CBDC, you can't really see it on its own. You have to see it as interaction with many, many other elements in the digital space, but also in the real space. It will shape and reshape many things, so you cannot see it as its own in isolation. So as the Deputy Governor pointed out, there are a lot of implications. How much do you allow fintech access to central bank balance sheet? And the Bank of England made already a big step forward in this dimension. Is also lender of last resort guarantees assessed coming along this space. And then there's specific CBDC as are you providing a worse app then compared to the private sector? What interest rate you pay on CBDC? What the caps? What are the privacy issues and so forth? It's all issues which have to be debated and discussed. And what is the currency competition across different countries from foreign CBDCs and also with private currencies popping up and tokens in private. So let me conclude. So I think what's important is to see the platforms and token issuers in context of CBDC and how to regulate it. How do you just impose interoperability and outlaw exchange fees, or do you want to use CBDC as legal tender? Compete essentially with the CBDC with private platform tokens or not, and how smart you want to make the CBDCs compared to smart tokens on the private side. There are different ways to do this. You can make CBDCs less attractive. You just said it's a fallback option if there's a crisis. There's some asset people can run into, and then you can channel it back depending whether the private bank is solvent or illiquid. or you can make the CBDC also a very attractive feature. And it's a question whether the official sector can keep up with all the developments in the private sector. There's the whole issue, which I didn't touch, about uniformity of money, the potential segmentation and information sensitivity which comes in. And most importantly, I think we cannot see CBDC in isolation. You have to see it in connection with bank regulation. As you see, this jamming back has connection with bank regulation, collateral policy, a connection with the whole fintech, and also even with the market structure on retail platforms. And finally, of course, privacy is a big issue as well. So thanks a lot for giving me this opportunity. I will conclude with these thoughts. I'm looking forward to the debate.
Thank you very much, Mr. Brunnermeier. So I think that before opening the floor for questions, I would like to listen from Jean-Pierre Landau, your preliminary remarks and your presentation.
Thank you. Thank you very much, Governor. It's a real privilege to be here. Thanks to you for having me. Thanks for Raphael for inviting me. I think it's the second time or the third time. It's always a very nice conference to attend. I will make a few very basic remarks on this topic, and some of them will echo exactly what Markus had just said, because, as you know, we've worked together on that. I think there are very legitimate concerns about the impact of CBDC on financial stability, and they have been mentioned by the Governor. There is a risk of disintermediation of banks, and since banks are the main provider of credit in the euro area, there is a risk for credit in the euro area. So this is well known. I will make a few remarks at the end, but as the Governor has invited us, we should also think about how CBDC can help on financial stability. And starting from very, very basic principle and very basic things, private money left to itself is unstable. This is a big lesson of history. Every time we had pure private money in advanced economy, just like the free banking area in the United States, we had a high frequency of crises, of runs, of financial panics. And after all, central banks have been created just to remedy the instability of private money. So this is clearly the point where we should start, and we should see that the real issue now is how to. We have lived 100 years, 150 years, in a sort of harmonious combination between private and public money. Digitalization is challenging that harmony, and we should think about what role the public money should have in a digital economy. That is the most important thing I think we should look at. Clearly, public money brings many benefits to monetary system. One is, of course, in the field of monetary policy. It fixed the unit of account. This is very important. We're not going to talk about that today. Markus mentioned the currency competition, and of course, the ability to create digital money reinforced the currency competition and the challenge to unit of account. But the second benefit in terms of financial stability that public money brings is what we call a uniform currency. This is a term which has almost disappeared from the central banking language, except in some publication by the Federal Reserve. It is very important. We tend to take it as granted that the currency is uniform inside our jurisdiction. And we tend to take it as granted that 1 euro is 1 euro everywhere, independent of the bank who issues the euro, independent of the place, and independent of the uses that we make of that euro. And with digitalization, this is something which we cannot take for granted. And actually, we have many, many reasons to fear that digitalization of money will bring big challenges to the uniformity of currency. I would mention two of them, and most of them have already been alluded to by Markus. First, there is a huge incentive to create very various forms of money. It's easy to create money. Any developer right now with a minimum of talent and access to a network can create money in its own form, right? So it's very tempting to create new forms of money with a lot of functionality attached to it. It's called nicely programmable money. But of course, once money is programmable, its value changes according to the program. So it's not a uniform currency anymore. We have to be aware of that. So that is the first threat to uniform currency. And the second threat to uniform currency is exactly what Markus mentioned, is the existence of network and platforms. And the business model of those networks and platforms is based on the lock-in factor, low interoperability with other networks, and therefore money is not interchangeable all over the country. The major, for me, the awareness came when I looked at what happened in China. You have those two big networks, Tencent and non-financial. Each has several hundred of millions of customers, but they are not interoperable. So if you have money issued by Tencent of your mobile, you cannot pay someone who doesn't have the same app. So, and that can, of course, demultiply an extraordinary number of times in an area where we are moving towards machine exchanging with machine trading with machine at high speed. So we can have both network access and programmable money and have pockets of private money everywhere, moving very fast in the forms of token, but with no real interconnection and big liquidity problem maybe arising in some part of the economy. So this is, by the way, the reason why so-called stablecoins are emerging. Stablecoins are providing money in token form in a very fast way, an easy way to use in the digital world. But some stablecoins are sort of exchangeable with others are less interoperable. So the big challenge for central banks is to reach all this part of the financial system and all this part of the monetary system in a digital economy with a money which is stable in value, which provide a uniform currency. So for me, this is absolutely the big issue in terms of financial stability, and I don't see how we can dispense of public money for that purpose. Now, I'm going to stick my neck a little bit, and in my view, what finally ensures the uniformity of currency is that every form of private money is unconditionally convertible or even redeemable in public money. This is exactly what we have today. We all assume that we have money in the bank. We can convert, this is private money, we can convert it into public money. This is our basic assumption. We don't do it, but we assume it's still possible. And that's why a euro deposit in one bank is equivalent to a euro deposit in another bank. There are two reasons for that. First, we can transfer the euro, and central bank money plays an ultimate role as a settlement asset. But the other reason is that we think it's convertible. Now, actually, it is convertible, but with some friction. And that there are physical frictions in using deposit money and changing it to cash. There are costs of holding cash. You may have to wait for the cash. So a lot of the convertibility in principle that we have between bank deposit and cash is actually subject to friction. And the problem of digitalization is that those frictions will disappear. And you will be able to convert private money into CBDC with no friction, just punching on your app. And that is the question which is raised to us, and that is the sort of trade-off that we have to manage. Disparition of the physical friction. Do we have to introduce an economic or financial friction to compensate for it? And this is actually, I think, if I'm well informed, the question that central bankers have asking themselves. And I have some ideas about that. I think in the spirit of what I said, full convertibility between private and public money, that means there should be a totally elastic supply on public money. Otherwise, there's no convertibility. Right? And to have a total elastic supply of public money, you cannot live with quantitative restriction. So I would be very worried if the central banking community would go to restricting quantitatively the amount of CBDC that each of us could hold. But they could price it. They could price it, and they could have a system which is called tiering, with several tranches. The first tranche would be guaranteed at no interest rate, either positive or negative. And then, if you go to some upper tranches, you could have to bear a negative interest rate. So the tranches would implicitly determine what central bank think is a good money for a medium of exchange, and when money becomes a store of value, then you can price it positively or negatively. And that would be, in my view, a good way to conciliate the total uniform currency for exchange and be able to face the store of value function of money. The advantage of that is, of course, that in periods of runs, when you have a flight to safety, when everybody would run to the public money, you can price it negatively as you wish. So it would give actually the central bankers an additional tool of financial stability according to their vision of whether the run is motivated or not, their reason whether they want to provide a safe asset to the population or not. It would give them an additional instrument to do that. So that would be my sort of modest contribution to the question. I would end up with a few remarks on banks. With a disclaimer, I have the privilege of being an independent member of the board of Santander Consumer Finance, which is a very nice Spanish bank, so I try to not to be biased by that. Oh, I forgot to talk about programmable money. Programmable money is of course, a sort of very attractive concept, and I think in our reasoning we should really distinguish two definitions of programmable money. The first one is that you have a unit of money, which is intangible, untouchable. It has always the same value to many people, but you can program the way it is transferred. So that's one approach, a smart contract. Okay, so I decide that I would want to make periodic payment or contingent payment to someone. I implement a smart contract, but the money which is transferred is always the same. It's the same unit. And then you have a second approach to programmable money, which says that the value of the monetary unit itself is contingent, in change according to some condition. For instance, some people would tell you that the government could, when they want to make transfer to people and they want those transfers to be spent, they could attach a deadline of validity to the money they send, so the monetary unit would not be valid after a certain date. You could also think that you could attach some condition. You could not use your social payments to buy alcohol or things like that. You know, so it's a lot of people are tempted with that, and it's a nice mix between fiscal and monetary policy, or directed and monetary policy. I would strongly advise against that for CBDC. I think the merit of CBDC and the necessity of CBDC is, again, to have a uniform currency, same information insensitive, non-contingent value all over the place. So it's up to the private sector to decide whether they want to issue programmable money, with the risk that may be attached to it, with the uncertainty that may be attached to it, with the benefits in terms of flexibility and practicability. I think the public sector should be very basic. It should issue a money public which has the same value all the time, independent of the time, place, and people who hold it and issue it. That is for me extremely important. So I would be concerned about CBDC, which would be programmable. Moving to the bank, this is a graph which we produced with Markus in our paper 2 years ago. What the banks may be facing is a change of industrial organization in financial intermediation. And of course, these are very sort of schematic graphs, but they are interesting. At the moment, we could characterize the system as bank-based, so the banks has the relationship with the customers. It does the credit, and the payment function and asset management of the services are sort of auxiliary. Right? And what we may see emerging with digitalization is a payment-centric system where the payment function is the one who gets you access to the customers, as Markus has explained, who gets you access to the contact people, and the rest, the credit and the asset management, may be auxiliary. That is, in my view, the kind of very dramatic challenges that the banking sector are facing. And I fully agree with what Markus has said a minute ago. You cannot think of introducing a CBDC without thinking of the whole overall structural changes, industrial organization changes that digitalization of payment is introducing in our economies. It is impossible. So the question, and Markus said it very clearly, the question is the relationship, and it shows clearly with those two graphs, the relationship between the payment and credit. And I think the regulator and the authorities have to think of what kind of relationship they want between the payment and the credit, and that will determine the kind of regulation that they will have. I think the current period where thinking about the structure and the architecture of CBDC should also be used for consultation with regulation authority and making sure, and this is a risk in my view in Europe, that we have a consistent approach to those problems across the different field of regulation. And I will mention three here, as echoing again what has been said. First, data regulation and privacy. We have a Digital Market Act, Digital Service Act. We have a lot of data regulation going on in Europe. Second, the nature of the requirement. Do you want to transform the payment service provider into narrow bank? Do we want to impose on them capital liquidity requirement or not? This is a... And third, and not least, who should have access to the central bank balance sheet in the future? And again, to sort of point out to two opposite corner solutions, you could have a solution when payment service providers do not have access to the central bank balance sheet. They have to go to a bank or create a bank themselves. That adds another layer to financial intermediation, but that preserves some of the purity of access to central bank balance sheet. Or you could have a system where a lot of people, like the Chinese did, have access to the central bank balance sheet, which gives, of course, the central bank an easier reach to many parts of the financial system. I think, of course, the question of who has access to the central bank balance sheet is not limited to digital money. I tend to think it's going to be one of the major issues in the next decade, starting from where we are with huge central bank balance sheets. But regarding digital currency, I think this is an issue that central banks should really think hard about. Thank you very much.
Thank you very much for this insightful presentation. There are many questions, of course, to how to discover the answers. This will be the role of the central bankers and regulators, of course. But this is, of course, food for thought, yeah. I'm sure, for the questions later on. So now, Jon, you have the floor for your perspective.
Okay, thank you very much, and thanks for inviting me. Bank of Spain for inviting me. I don't know whether it's COVID or the old other event, but the channel has seemed a bit deeper and a bit wider for the last year or so, so it's very nice to come across it and discover friends on the other side. There's a famous British poet called Shelley who remarked of his mother-in-law that she had lost the art of conversation, but not, alas, the gift of speech. And I feel a little bit like that because I stand between you and some fantastic artwork and dinner. I have no slides. I follow two excellent and detailed speakers, and many of the controversial and insightful points I was going to make have just been made. So what I'll try and do is talk about this from the perspective of a central bank that's wrestling with some of these issues and how we see it and the context in which we see it. But I don't imagine I'll add a whole lot to what's been said. But just to, my first point was going to be that the financial stability risks around central bank digital currency maybe are more to do with not introducing one than introducing one, but Margarita started off there. So maybe I'll just explain why we think that. So in the UK, the use of cash is falling. It's falling faster than in continental Europe. Pre-COVID, 23% of transactions were done with cash. 2008, that was 60%. During COVID, it dropped to 17%, and there's no sign that it's going. Sweden is ahead of us, but we're catching the Swedes up fast. And we all know what is driving that. It's digitalization of our lives. It's not just online shopping, it's just the way we live and interact with others. And even for face-to-face, it's convenience. Over half of the credit card face-to-face credit card transactions are now contactless through the card or through Apple Pay, and that is growing. And as a result, 95% of the money that is in general circulation in the UK is private sector commercial bank money in electronic. We used to say electronic, now we say digital form. 30 years ago, it was 60%, and by far the majority of transactions were actually carried out in public money, physical cash. And of course, as we know, the state does not issue digital money, it only issues physical money. So put simply, public money issued by the Bank of England with that famous promise of paying the bearer is fast becoming less useful and less used as a result. Many places now in London will not accept cash. I defy you to buy anything with cash in the middle of Stockholm. So this is all happening with existing technology. This isn't crypto. This is happening through banks, card companies, automating clearing houses, just existing payments rails. But at the same time as we're facing this question of public money becoming less used and less useful, we see these newer technologies on the horizon using cryptographic techniques, which will establish completely new rails that don't go through the banking system or through the central bank, and actually will bring in new players who, as Jean-Pierre and Markus have said, can disaggregate the current payments, deposits, business model, and actually pick which parts of the business model they want to do. Now, I'm not going to go into the bewildering world of crypto assets in general, but do need to say a word about the area of crypto that's most relevant to payments, which is the stable coins. These are denominated in existing currencies in the main. They're backed by assets to maintain a stable value. They're not issued by banks. They're not a claim on a bank. Libra and Diem are the most famous, and I think it was actually Facebook's announcement they were going to do something which was a wake-up call to policymakers. But they're not the only ones. There are already a number in circulation. Tether and US DC are circulating primarily in the US, but actually these are used at the moment mainly for crypto markets. So if you want to buy Bitcoin or go in and out of different sorts of crypto assets or get involved with smart contracts on the Ethereum platform, you will use one of these stable coins, but they have ambitions. So I know for certain that USDC wants to be a bank, it wants to provide kind of retail payments, and it wants to come to the UK. So these are things we're facing. It's easy to say they're small. I think it's less than 100 billion at the moment, but Uber was small and Airbnb was small. They were not part of Facebook or Amazon, but they grew very fast indeed. So we shouldn't just think about big techs. We should actually think about challengers who could achieve scale quickly. So we, from the bank's point of view, we were already facing the disappearance of public money, state money, from citizens' hands, and now we're facing the prospect of that accelerating and adding new players, and I won't go into Markus's point, but a much more diverse ecosystem of monies and payments in the economy than we've been used to seeing with the banking system. And that's really the context for why we're exploring CBDC. It isn't really about China, and it's not because it's nice to have a technological edge. It's actually because this prospect is, frankly, one that's concerning. So the key question, really, which we've been asking ourselves for a couple of years is, does it matter? I mean, does it matter if citizens don't have access to state money in a usable form? And, you know, you can say the state must provide money, but actually, state in the UK doesn't provide electricity anymore, it doesn't provide water. So you do have to start, if you're thinking about a CBC, saying, well, actually, why should we provide public money? And as well as financial stability issues, this raises, and I think Markus touched on some of this, other public policy issues which are not really the primary province of central banks: competition, inclusion, privacy, law enforcement. There's a whole range of other issues around the monies we use and the way we use them. I'll just note in passing for if any of you are really sad and have got nothing to read next weekend, the G7 put out public policy principles for CBDC last week in Washington. These are not primarily about financial stability. These are about setting out a framework of public principles to cover issues like competition or privacy, because I think the political authorities are beginning to realize that these questions affect them as well. But I'll touch upon that briefly in a second, but turning back to financial stability, the question really is, what role does public money that's recognizable in the hands of the citizen play in anchoring confidence in money and the monetary system in normal times and in stress, and preventing runs, not out of banks, but runs out of money? And secondly, what role does it play in ensuring the uniformity of money, which both Markus and Jean-Pierre have talked about at some length? But just to say it again, I mean, all the private monies in our economies are interchangeable, at par, denominated in one unit of account, sterling in our case. You know that you'll get 100 pence in the pound back, and the public actually probably doesn't know what monies it's using, and I'll come back to it. Now, you can argue that you don't need a central bank currency to achieve those things. You can achieve them by regulation. You can regulate interoperability. We tie the banks together by requiring them to settle in central bank money between themselves. We could bring that in for stablecoin providers. We regulate them. We provide deposit insurance. We provide a liquidity line from the central bank in stress. And provided we can bring new players into that system, the argument goes that the public has confidence in private money and it doesn't really need public money. There's another point of view, though, which really goes to the perception of money that people have. So I said before, most people in the UK don't know what money they're using. I don't know that. We're 65 million people, and I haven't asked 36 million the question. But if I ask people what they think they're using when they transact, and when I tell them that they're not actually using Bank of England money and the I promise to pay doesn't apply to them, I get baffled looks. In the sense, and the impression I get is in normal times, most people don't think about this. They don't need to think. It's a good thing that they don't think about this. And a caricature would be that they kind of see their banks as a safety deposit box into which they put their money, which is a kind of immutable thing, and then they take it out. You hear people say, my money is kind of in the bank, I want my money out. And the dominant image in people's mind of money is that central bank note. And of course, when you get into stress, people then realize that this is the safest asset, and they run to that. We saw that in COVID, that while transactions using money went down, the holding of money went up because people saw an emergency coming and they wanted state money. The fact that you can have this interchangeability, this uniformity of money that others mentioned, is not just due to the fact that we require the banks to do that and we require them to settle in one unit of account. It's because anybody can go to the ATM and sort of change their private money into public money, normally without realizing what they're doing. In a bank run, they realize. I saw the queues outside Northern Rock in 2008. And this ties actually our whole supervisory system for deposit-taking banks, because we require them to be able to meet that sight deposit promise that they will exchange their money for state money at par on demand. And if you think about it, our capital framework is actually established on that requirement. Now, I'm often asked the question, which has come up today, well, if we have frictionless access to public money, you don't have to stand at the ATM, won't that be a financial stability risk for bank runs? And I'll talk about that in a moment. But maybe a more foundational question is what would happen in a systemic banking crisis if the public realized that there was no escape route from private money? Now that sounds crazy, we're not going to have a crisis like that, but actually we did have a crisis like that in the UK in 2008. And we thought at the time that our three pretty much biggest retail banks were in danger of going into insolvency, And somebody turned around in the meeting and said, you do realise that is nearly 60% of the money that people hold in the UK will be locked up in an insolvency. And the issue is, if you get to that situation and people actually realise that there is no safe asset, do you start to get a run out of money itself and a loss of confidence in money? And money is quite a fragile social concept that works pretty well while it works, but once confidence disappears in it, it tends to have a dynamic that's very unpleasant. So the primary financial stability question for CBDC is what are the implications for me? What are the implications of allowing public money to disappear, especially in a world where we'll see many more forms of money and new forms that are quite difficult to regulate, and non-bank actors. And this is not just about financial stability, as I said. Those other public policy objectives, competition, privacy, inclusion, law enforcement, as Markus said, can be anchored not just by regulation, but by the competition of a publicly available safe asset that sets the standards. Now, I'll turn very briefly to this question of the financial stability impact on the banking system. I'll make two very obvious points. One, it depends upon how a CBDC is designed and implemented, and two, it depends upon people's behaviours, the amount of demand they have for it and how they would want to use it. On the first, all of the advanced economy central bank exploration of CBDC is about the platform model, where actually the central bank provides the coin and the infrastructure, but the private sector, not just banks, non-banks as well, could provide the interface with the customer, the wallets, and the services. And as far as I know, no central bank is thinking about giving every citizen an account at the central bank. I say no central bank because I was in the States last week and it became apparent that there are some in US politics who are thinking exactly that wouldn't this be a great way to democratize finance, to give every citizen an account? And look, it's not inconceivable, and the technology would allow it. I'm going to rule that out for the moment. I think that has very different financial stability and money creation implications. But on the second question, on how much would people want to hold, look, it's impossible to predict the demand for something that doesn't exist. I say to people, you know, you couldn't have predicted the demand for smartphones and what they could do in 2005. So the best we can do is to model on existing preferences, but be very aware that the modeling we do on the here and now may well not be relevant in a future state when people have access to something that they don't have at the moment. And again, you hear two arguments. One, that this will run away with us, you know, and will disintermediate the banking system. The other is that there's no need for it, and therefore nobody will want to hold very much of it. And I guess the truth is somewhere in between, and it will be determined by the choices we make. The Bank of England modelled the impact of 20% of bank deposits moving into a CBDC. 20% is about £400 billion. It's equivalent to the non-interest-bearing deposits, the essentially transactional deposits that are held in the banking system. And we model the impact on credit spreads and on bank returns on equity, assuming that banks would replace the lost retail deposits with wholesale market funding with a spread of about 200 basis points. Current spread's about 63, I think. So it's quite an extreme example. And at a funding spread of 200 basis points, if that 400 billion plus moved, we estimated that ROEs would be reduced by about 90 basis points, less than 1%, and credit spreads would increase by 70 basis points. And then banks would lose some access to the revenues they make from payments, and we'd probably see some increase in non-bank finance in the economy already. Other central banks have done similar work. They all come to broadly similar conclusions on the basis of what we can model now, but it's subject to this caveat that we don't, of course, know what would happen. So this means, I think, that, in my view, the probability on what we know now is that with careful design and implementation, a CBDC, the impacts on the banking sector should be manageable. But it also means we need to proceed pretty carefully because you don't know how a thing like this will take off, and you need to learn a lot more about the behavioural response before you can be confident about some of the judgments I gave you. We may need controls. People have talked about limits on holdings, on transactions, on access, on eligibility. You know, you can't go into your bank now and pay in or take out large amounts of money without somebody appearing, if you can find a real bank, without somebody appearing to ask you some very probing questions about where your large amount of money came from. There's only a certain amount you can take out of an ATM. The limit on contactless has just gone up to £100, but you can't do more. So I'm not so sure as others that the public wouldn't accept limits on holdings or limits on transactions. But clearly it'll be different in different jurisdictions, and you know we'll have to see what the societal point is. But I suspect if we do introduce a CBDC in the initial period, there would have to be some controls to avoid us winding up in the extreme, in one of the extremes. And at the same time, there are some FS benefits I didn't mention. One is that the payment system would be more resilient, and actually we'd be able to resolve failing banks without having to worry about what happens to the money and the payment system that they hold. Finally, I've concentrated on domestic. I'm not going to talk about cross-border, it'll come out afterwards, but there are some big cross-border financial stability issues which we shouldn't ignore. What's called digital dollarization, the ability of people to fund themselves cross-border in a more frictionless way, you know, a digital dash for cash of the sort we saw in March 20. But I mean, maybe we can explore those afterwards. But for me, I'll go back to the fact that I think if we don't do this, given the speed the technology is moving, we need to be pretty sure that we can manage the consequences of a very different form of money circulating in our economies. Stop there, Margaret. Thanks.
Many thanks, Jon, for, let's say, the central bank's perspective, which is always cautious and conservative, I would say. So we have listened to three different perspectives, all of them complementary. So now I would like to, let's say, open the floor for questions from the audience, and including, of course, the online questions. Who's going to break the ice here? No one? Please. You in the second row. Have a mic, please.
Okay, thank you. Can you hear me over there in Princeton? Good. You were saying, and I wrote this down here just to quote you correctly, CBDC may unbundle loan business from deposit taken when you were comparing banking with CBDC. And I underscored may. I would, if I hadn't listened to you now, I would have said 2 hours ago, it will necessarily. Can you imagine a world in which CBDC does not severely impact deposit banking as we know it? And wouldn't that imply that we have to think at least 4 times as carefully about CBDC as you suggested in your introduction?
Should I respond right away? Or?
Yes, please.
Thanks, Ilo. Yes, I can also imagine a situation where, you know, CBDC doesn't have all the nice app features private money will have, and people will not, you know, necessarily use central bank digital currency directly because it doesn't have the same convenience and has some other handicaps. And actually, if you think about in the US, you know, you can always have the US Postal Service, or we also had in Germany, for example, you could have with postal service some bank account. Of course, it will draw some, but it's not necessarily drawing all the money away. So I think that depends how much it's designed and how attractive CBDC will be made. It could also be that CBDC is not paying any interest and private deposits will pay some interest. So there are many design features on the CBDC front which can make it more or less attractive. And that's why I still stick with my name. I think the danger is probably not so severe at this stage. It's more in times of crisis when uncertainty pops up, then how will then the system, how will people react to it? I think that's more a bigger thing we have to think about carefully.
Please,
but I share with you the concern that it might happen, so that's, but I don't know, I wouldn't make a 100% prediction with probability 1 at this stage.
Please, Jean-Pierre.
Yeah. I'm just wondering whether it's not the question which is broader than CBDC. It is the technology which may unbundle the payment and the credit. And so whether we have a public digital money or not is of course important. But at the root of the question is the technological evolution, which again allows you to set up a payment system based on totally different architecture and industrial organization than the one the banks are using, based on relationship between customers which do not go into counterparty relationship. At the moment, we have a payment system which ultimately relies upon a network of interlocked balance sheet, as we say, between banks. Now we see a payment system which is becoming totally independent of the balance sheet because it's token-based. It's totally independent of the balance sheets of the participants, right? So this by itself, whether we have a public money or not, I think we should, but whether we have a public money or not, this by itself is a total change in the industrial organization. So I would certainly try to put the question in that broader technological context.
Yeah, I might just very quickly. So I don't think it's axiomatic that it will. People could do that now if they wanted to, but it might. But actually, you know, when banks make a loan and put the loan, create a loan and a deposit at the same time, which is creating money. There's plenty of people who do credit intermediation at the moment who aren't licensed deposit takers. I mean, basically half of our credit intermediation comes through non-bank finance. It's the money creation part, and that's the part the banks do. And they create a loan, and they create which is not liquid, and they create a liquid thing called money, which they put in the deposit account. And the thing that translates the illiquid loan from the mortgage to the liquid thing called money is the bank and its standing and its reserves and the fact that it's a claim on it. And if that deposit then moves out into the stablecoin sector, and it would then, depending on what the stablecoin backs itself with, or if it moves into a CBDC and then it's at the central bank, then you have to think about how the flow will come back into the banking system. But it's not to me, and of course banks can borrow in the wholesale market where those deposits will be. So it's not to me axiomatic that the deposit-taking function and the lending function have to go in lockstep. And it's also not axiomatic that the money creation function and the payments function have to go in lockstep. So when you tell me to think 4 times as cautiously as I'm thinking already, we're now at the power of 10 or something. But I think it's just important to separate those bits. We think of it that way because that's how it is now. It's not how it's always been. And I think part of the challenge of this whole subject is to free ourselves from the way we think at the moment and try and imagine a different world, because I suspect we're going to be in that world whether we like it or not.
Okay, next question, Santiago.
Thank you. Santiago, in which cash is disappearing? I think in many countries, it seems that the main reason for considering issuing a CBDC is more the competition of stable coins or other CBDCs. And in this case, I mean, I've seen recent publications by the BIS, the willingness for coordination among a group of central banks. There is an increasing, apparently, messages in that regard, but there is a question of first mover. So who will move first? And apparently China is a candidate. No? If China moves first, then given the peculiarities of China, probably we should think about the second mover problem. But in any case, the questions raised by this coordination are complex, including access by non-residents, capital controls. I mean, so how will we deal with all these spillover cross-border effects, thinking, for instance, from the point of view of countries with a high degree of dollarization, or, I mean, problems of capital flight? I mean, all these cross-border issues, how do you think could be addressed?
Thank you. Maybe Jean-Pierre, you could start?
Yeah. At the moment, I think the countries which are more concerned by what's happening in terms of currency competition are, I would say, the middle-sized emerging economy. These are countries which are big enough to care for monetary independence and small enough to be exposed to digital dollarization or digital euroization. So it's no coincidence, in my view, that these are the countries which are at the moment moving very, very fast into creating CBDC, because they don't want that the only alternative of public money that their citizens are offered in digital form comes from abroad. They want it to come from inside. The second point, I think, is that China's move have been, in my view, a little bit misinterpreted. There is this narrative that China wants to internationalize the renminbi through digitalization. It may happen. It may happen because it may be that China tries to internationalize its currency by using the medium of exchange function rather than, as the US uses, the store value function. But at the moment, from what I see, it's mainly a defensive move, right? China was exactly in the situation that Jon was describing, no cash, and all the money was handled, all the payments were handled by two big private entities whose leaders were very well known by the general public, and nobody knew there was a People's Bank of China, a central bank, and who was the governor. So it was really a matter of sovereignty that the whole money was handled by enormous private agents, and I think the Chinese reacted to defend basically monetary sovereignty, which is the ability of the central bank to ensure that there is a uniform currency, that this uniform currency is denominated in the official unit of account, and they took the series of measures, including, of course, the creation of the digital yuan, but there were other measures. There were the obligation to deposit their reserves at the central bank. There were the creation of a centralized clearing system where, in fact, the government gets access to all the information incorporated in payments. So it was really a kind of sovereign reaction versus the dangers of the emergence of private actors.
Maybe something on cross-border payments, Jon?
Okay, I'll just make a quick point on this. Look, if 60% of transactions were happening in physical cash, I wouldn't be worried about stablecoin. I mean, the fact is that it will accelerate something that's already happening, which is why the two things come together. But you know, a small amount of digital currency, if there was a large amount of public money available, then the questions I posed wouldn't apply. And just from a central bank perspective, introducing a central bank digital currency is a kind of huge undertaking that will need social acceptance, and doing it because China's doing it is just not a good reason. So, you know, this is something that will have to work in the UK and be accepted. And actually, we debate in the Bank of England second mover and third mover advantage on the grounds that this is difficult issues here. Should we let somebody else go first, and we can learn from their mistakes? So we see this very much in a domestic context, and the reason for doing it and for limits or whatever you do is quite jurisdictional. Not true politically, and you know, I'm sure there are some politicians in Whitehall and some politicians in Brussels who are desperate that the ECB has one before the Bank of England, or vice versa. But it's just not a really justifiable reason to do this. On cross-border, it's got to make sense in a national context first. Cross-border, I'd say three things. One, our current payment systems for cross-border correspondent banking through the clearing it through the central bank channels, or even the linking up of faster payment services. We put those technologies in place before we thought about cross-border operation. And I know now from my work in the CPMI and on the G20 roadmap, it is really difficult to try and retrofit common standards, sort of common technology to that. So the first thing about cross-border is if we're starting with a clean sheet of paper, doing something that we think makes sense in our national jurisdictions, if it does, let's not have differences by accident, you know, or because we like one idea more than another. If we're going to have differences, let's have that on purpose. And second, to me, cross-border means the ability of a user of CBDC to make a payment in another CBDC or another country. It doesn't really require non-resident holding. There's a big issue about non-resident holding, but it doesn't require that. And it can happen at different levels. At one level, it could happen through just aligning the standards we use, using the same APIs or technological interfaces, so that it would be a bit like correspondent banking that worked properly, if I can put it that way. At another level, we can choose to actually share sort of interfaces and to have pre-funded liquidity so that you can move from one to the other. And, you know, a final possibility is that a number of countries build one together. And really, I don't think people have got to the point of where they're going. I imagine initially it'll be the first rather than the second, but there'll be a huge benefit from saying, are we creating frictions? If we are going to create cross-border frictions, can we justify why we're creating them? I think that by itself will give you a huge benefit.
Markus?
Can I just echo what John said earlier and combine it with Jean-Pierre's recent remarks? I think what's really important to understand in using CBDCs, it's actually important to avoid the run on money. So there's always a debate run on banks, but it's really the run on money. And that's especially for smaller emerging economies which are concerned about that. You suddenly lose your own unit of account. So the unit of account is the key to control monetary policy. And you can see that that's what Jean-Pierre pointed out, that the medium-sized emerging economies are very concerned about that. And that's why the run on money, not the run on banks, is the key driver. With respect to China and the first mover advantage, I think from an international perspective, it would have been better for China to wait, because what you see essentially is that Alipay and WeChat Pay is also used outside of China more and more. So you can see, for example, in the United States, I have a lot of Chinese friends who buy their Chinese restaurant and pay with Alipay, and you use renminbis within other jurisdictions. And once you move it away from Alipay, move it to something official, there will be much more skepticism in other countries. So if they wanted to establish the renminbi as an international currency, they should have let the private companies go abroad, and they really had a drive to go abroad international, and then take it over at a later stage. So that's why I think I subscribe also what Jean-Pierre said. It's probably more internal motivations, domestic policy motivations, which made them move in this direction rather than establishing the renminbi as an international currency. Because otherwise, my rationale at least would be that they should have done it later.
Okay, there was another question around there. Yes?
Hi, thanks for the presentation. I want to come back to the issue about interoperability. It is basically, you mentioned a scenario where you add several functions to the money, then it could create some kind of fragmentation. In this sense, the CBDC will be a tool in order to avoid this fragmentation. There are some areas like for example, the digital identity, where clearly are out of the scope of the central banks. Then central banks basically look what is happening in the digital environment and try to adapt this to the CBDC. There are another areas, like you mentioned the programmability issue, where for me it's not clear what could be the role of the central banks in defining some kind of standards, some kind of rules for the programmability of the money. Then what do you see there could be a role or not for the central banks? This basically should be out of the scope of the central banks, as will be decided in a digital environmental from the other regulators. And the second question is related with another way to achieve this interoperability is by the regulation itself, as Jon was mentioned. And here, this could be feasible. That here in Europe, we have the experience of the PSD2 and how hard it is to reach some kind of interoperability between the fintech and the banks in some sense. Then this will be feasible with this kind of big techs, with a global scope, with this huge capacity on making some progress for the interoperability. Do you think that really this could be achieved through a regulation, or the reality is only that by developing some kind of CBDC this could be feasible? Thanks a lot.
Who wants to start? Jean-Pierre?
Yeah, I'm not an engineer, and of course interoperability is most likely about technicalities and detail. I sort of think if we try to standardize interoperability, as any standards, you will be faced with the dilemma of having something stable and having something innovative. And I'm afraid, I'm not sure the central banks are absolutely equipped to do that. That's why personally, but that's a very personal view, I would rather go in the direction that Markus said, having the public money as legal tender everywhere in digital form. Meaning, I would put the requirement that every single token which moves around, sometimes in nanoseconds now, is designed to be in such a way that it's convertible into public currency at any single moment of time. And that would allow, by the way, the central bank to reach the different part of a segmented digital system. And I think that would sort of mimic the organization in which we are, where some banks have their own sort of private money network, but they are connected through the central bank as a settlement, the central bank money as a settlement instrument. Intuitively, I would rather look into that kind of architecture rather than trying to legislate interoperability. Now, other authorities, like competition authorities, may, of course, have something to say about interoperability and limiting the effects of lock-in. But for me, it's not prioritarily a job for the central banks, although they should be aware of that and they should act, of course, in a consistent way.
Yeah, sorry, do you want to?
Yeah, please, Jon.
Yes, so the barriers to interoperability are technical barriers, commercial barriers, and legal regulatory barriers. And you have to think about what's the best way of addressing, if you want interoperability, which I think is kind of a public good, then you have to think about how you address those. If you have convertibility into central bank money, it's what we find at the moment. The central bank has huge influence over the standards that are set, because in the end everything's got to be able to come into the central bank system. Not complete control, but it has kind of huge influence. Legislation, the law of the money is very different in different countries. Legal tender means very different things in different countries. But again, the regulatory system, which banks and other authorities control, can kind of ensure that your requirements, that's what I meant before when I said your obligation is to exchange it at par on demand, will then kind of anchor that. Commercial is quite difficult. So there are different views on this. Should we force merchants to accept a CBDC? I mean, maybe they won't want to, and they might not want to at the beginning because not many people are using it. If you look through the paper that this group of central banks, G7 plus Switzerland and Sweden, put out, there's differences of view about whether you could actually compel people to accept a CBDC. But the one thing I'm pretty sure of is that it is easier to do it with regulation and an alternative public sector currency that's got to be interchangeable than it is to do it by regulation alone. And my evidence will be, just look at the struggles we've had with the telecoms companies and the public utilities about interoperability. On telecoms in particular, new technology coming in all the time, it's been a constant struggle, to get the idea that one person's telephone lines can be used by someone else. So I'm not confident that regulation by itself is the answer. On digital identity, this is an issue for governments. I think central banks can tell governments what is required for an efficient CBDC, but if we're going to make people do that, and it doesn't have to be a government agency like in India. In Sweden they are using the digital identity that the banks developed for Swish to identify themselves for health purposes and vaccination. So there can be private sector solutions to that, as well as public sector ones.
Markus, would you like to add something?
Yeah, so I think I'll just echo what was said earlier. I think the whole idea of open banking and all this, you will see there will be more competition if the regulation is done well and less lock-in effects, fewer lock-in effects. About this CBDC as legal tender, I think that's one way to go, but it has its drawbacks as well, because you might undercut sovereign credit provisioning, which you can have through platforms which might, be able to enforce repayment through their own tokens, but they might not be able to enforce it if people can avoid it when they sell them their product, let's say, against CBDC rather than the token they promise to sell, and then it will be collected automatically by the platform. So there's some drawbacks, and one has to think it through carefully. And it's actually not an easy answer. It's the ideal level of legal tender. So there might be ways when you make legal tender very, very powerful. It might be counterfactual and counterproductive in a sense of credit provisioning on the other hand. So there's a balance to be struck. The details still have to be figured out, I think, what are the advantages and disadvantages. I think there's a lot of interesting research to be done in that space to figure the details out. And I know less about knowing your customers and all these policies which has to be enforced as well, which might be part of the realm of central banks or go even beyond the central banks aspects.
Okay, there was one more question here.
So my impression is also that the current discussion about CBDC is a response to private, so the emergence of private digital currencies that infiltrate portfolios, private portfolios, but maybe also portfolios of financial institutions around the world, might raise the risk that at some point you have, in a way, a bailout expectations, at least a lender of last resort by market participants, with respect to these private digital currencies, if you call it that way. And my question is, how do you prepare for that? A few days ago, there was an article in the Financial Times on the discussion among Republican politicians that regulation by Democrats in the US on the digital currencies should be very careful and cautious, because this is now an established private asset. I mean the private digital currency, and we should protect that, which is, in my way, one step in the direction of making this a true asset, which is also be safeguarded by the central bank. Do you see that risk being drawn into a regulatory obligation, basically?
Maybe you can start with the central bank point.
If we're talking about stable coins now, you're talking about crypto assets generally? Yeah, so I draw a distinction. I've been talking about things that people use to pay, not as a store of value. And I think if people want to speculate on stores of value that have 40% less value one day and 60% more value the next day, I wouldn't stop them. I think there are huge issues around investor protection, market integrity, fraud, money laundering, which, if it gets to a big enough scale, could be a financial stability confidence point, as you say. But I think, I think they need to be brought under that regulation, because when a lot of people lose a lot of money, they generally say the state needs to bail them out. But also because we're seeing these things get into, as you say, get into the financial sector. But they don't. That goes to me to the question of, I used this analogy last week and got told off for it, but I think it's true. 1.2 trillion worth of subprime got deeply enough into the financial system to bring it down. Hasn't happened yet. The crypto stuff is still quite separate, but you can see it happening quite fast. So I think we have to think about financial stability of a crash in these assets and a loss of value. I don't think we have to think about financial stability of these assets being used as money as a means of transaction, just because of the volatility of their value, because they're not backed, unless they're stable coins, in which case they are backed. So who pays with Bitcoin? Well, some people do because it escapes central banks and it's kind of libertarian. Most people do to evade some sort of law or control. I don't see unbacked assets with volatile value becoming means of payment. Their financial stability risk comes through a different channel, which is the risk of a price collapse when the thing has become integrated. It also worries me, but CBDC is not the answer to that. The answer to that is investor protection, market integrity, and crucially, and I'm addressing the chairman of the Basel Committee, ensuring that when banks get involved in this business and take on balance sheet risk, they have capital that reflects the fact that there is nothing stands to support these assets in that way, to ensure that the system as a whole is kind of protected.
Would you like to add something, or Markus?
Yeah, I just want to say I very much agree with what Jon said, and I just want to draw an analogy with money market funds. So money market funds have the breaking the buck rule, and essentially that is now used as a marketing tool to promote money market funds, and it was initially it was intended to have a regulation in place in order to make them safer. And that's the same problem we will face with the crypto space as well. That, there will be a drift towards having them regulated, and once you regulate them, there will be the expectations from the public and the investors to have some bailout guarantee on the other hand. And that, to handle this and this complication, that's a tricky thing. It goes a little bit beyond CBDC, but it's a tricky thing to do on a. Yeah, for me, the money market fund breaking the buck rule in the United States is a good analogy. Outside of the regulatory perimeter of money market funds, and this regulation breaking the buck rule is used as a marketing tool.
Alejandra first, I think.
Thank you very much for such an interesting conversation. No? I think
No.
we need more of these conversations because this is such a complex issue and so big. So every time I go to these seminars, more and more questions come to my mind, no? But it's been very fascinating, thank you. I have two questions, if I may. One is on the very important issue of the decoupling of the deposit and the risk function of banks, if this goes ahead. And I wanted to ask about the concern that banks might not be able to provide or do the risk assessment function as effectively as they do today if they are if we lose the payment function, let's say, no, and we lose the access to all that data and to the customer relationship. And my second question, as I work for Banco Santander, is what do you expect from banks in all this conversation? What kinds of questions can we help you answer? I know that there are, in the UK and in other countries, interesting and important working groups between the private and the public sector, and it would be great to have any guidance from you on what you expect from banks. Thank you.
Who wants to go first? Markus, would you like to take this one?
Yes, I can say a little bit about the decoupling between deposits and lending. Whether this will affect the risk assessment, that's hard for me to say, but I think, of course, there's a lot of data in transactions. So if a lot of information in the transaction data, if the banks don't have this, and I don't know to what extent they make use of it at this stage, I know from the platforms, Alipay and these companies, for them, transaction data is very valuable information. They use it as they call it information data is collateral. And so it might affect the performance of scoring models and other things. But that just means that's attractive data, and the bank should be willing to hold data on the deposit business in their business and have to offer them a higher deposit interest rate in order to keep the depositors with them. So it's just essentially customers, deposit holders essentially pay with their data to some extent, and then they need to be compensated for that. And there will be more competition in that space because a lot of platforms will move into this space as well and try to combine these data with other data. And with all these new tools, machine learning, deep learning, and all these tools, there's probably many more opportunities out there compared to what's already done currently in the banking system. And I think that makes having everything under one roof more profitable. These are the synergies I was talking about early on. And there should be that threshold, keep it under one roof, but the bank should also be willing to compensate the deposit holders for providing this data.
I'd just say, I mean, there are different models in different parts of the world, but one of the things we've been trying to do in the UK for a number of years is to open up bank data so that other people can use it. To be honest, credit intermediation for small businesses is not great through the banking system in the UK. It really isn't. It's been a problem for about 70 years, and we haven't managed to solve it. And one of the things we're looking at, long before stablecoins and crypto and CBDCs, was whether SME data should be available in some sort of credit register so that others can take it on. So, you know, to me, I don't start from the place that credit intermediation is brilliantly done. Majority of UK bank exposures are mortgages. I look at the US. I'm not sure I want that system over here, but the majority of mortgage originators are not banks now in the US. So, you know, I think banks will have to and should compete on what they can offer and the services, and competition is good. It's a harsh statement, but it's not the job of the central bank to protect a business model. It's our job to ensure that there can be transition and competition for more effective financial services without financial stability risk, which is what I meant by, you know, we have to be careful about the transition and unintended consequences and the like. But I think it's a world where I think banks, and in the UK they've exited some businesses because they kind of, if you like, no longer want to be in them. I think my biggest example of this is cross-border payments. You know, Libra came along because, you know, there was an obvious gap in the market, and the gap was there because we've had 30 years, 40 years to fix the 1950 system, and we haven't done it. So my sense is these new technologies bring competition and they bring innovation, and I think the smarter banks will you ask what banks can do. Certainly when I talk to the big banks in the UK, they're probably just being polite, but I don't get a kind of you must not do this. I actually get a kind of you ought to do this because we're much more worried about big tech platforms than we are about you. But I think what banks need to do is to think about how they can use these technologies and how they can provide services. And it seems to me quite possible that a bank might want to issue a stablecoin. You know, not as a claim, not as a deposit claim, but as a kind of back stablecoin. I'm sure they'll offer wallets, they'll offer sweeps back into bank accounts, they'll offer interest. So I think it's thinking about what you can do with the opportunity is crucial.
Jean-Pierre.
I think the first question is really at the heart of what policymakers should wonder in the next 3, 4, 5 years. Especially in Europe, where the European economy is very much, continental Europe is very much dependent on bank credit. So I think what kind of financial intermediation, what is the role of bank credit? Is it necessarily linked to payment? Because there are many links, including the one that Alessandra just mentioned, collection of information. I don't think we have an answer now, but I think it's very important that all the authorities which have something to say or to decide on this issue look really at the issue on a broad base. The second point is I think easier to answer. For me, it makes clear that the payment system is evolving towards payments which will not at each and every step means that you move money from a bank account to a bank account. the tokenization of money is going very far into that direction. And it is for, of course, I would say households and ordinary corporate customers, but also for this kind of new exchanges, new contracts which will take place in the digital economy. You have that wonderful phrase by Hal Varian, who is the chief economist of Google, and said, there is going to be a computer in the middle of each transaction, right? And so each transaction will be computerized and digitalized, and the payment instruments which will match that is a token. So what the bank can do is provide the tokens that the economy needs. I understand this is the sense of the European Payment Initiative. I think having a system where all banks provide the same token, interchangeable, interoperable at the euro area level, that would be an extraordinary contribution for the progress.
Thank you. Rafa?
You advocated the unconditional convertibility of private into public money. And I agree that this would be highly desirable, but how can you enforce this in a market economy? You could do it in China, I guess, but maybe not elsewhere.
I think there are many issues behind that, and the answer I don't have the answer to the big conceptual issue. Can the mix of capital regulation, lender of last resort, deposit insurance provide the same kind of safety in the private universe than the central bank digital currency, right? Now, the way we provide that convertibility right now is clearly for the lender of last resort function. So today we all know that we can convert, and we know that there is an institutional mechanism for the lender of last resort function which ensure that convertibility. So, and if we don't want, if there is a bank which issues money which we don't think is worth convertibility, we say it, and that money becomes a totally different kind of money. So for me, it is really the basis. I understand that some people think we can dispense of it through this kind of lender of last resort, deposit insurance and capital requirement, and make money safe, private money as safe as public money through this. Finally, I have a question which is running, and maybe you're best equipped to deal with it. It has been running in my mind for the last 2 years. Let's say I have a government bond, and I'm a non-banking actor. So a government bond is a promise to pay me back public money. What is the value of a government bond if there is no public money again in the economy? I've been struggling with that question, and I think this is at the heart of our financial stability concern. Because if we have to price the government bond into private money, then we have two stages of pricing. We must price the private money with all its uncertainty and value, and we must price the government bond into private money. So, if only for that, I think people who hold enormous amounts of government bonds should have access to public money. Otherwise, they cannot price those bonds in a safe way. So, if you talk about insurance company, pension funds, they hold enormous amounts of government bonds. You can dispense of CBDC if you give them an account at the central bank. That's the only way you can do that. Otherwise, you have to think of something. So I just throw that to you because I think it's a very interesting conceptual issue.
Yes, please.
I have to think about that one, Jean-Pierre, a little bit. But at the moment, you get paid out on a government bond in commercial bank money, because unless you come to the central bank, we used to give you banknotes, some nice pictures of the Bank of England.
But it's convertible.
But it's convertible. Yes. Yeah. On convertibility, I think there's an easy answer to part of the question, and there's a difficult answer to the hard bit of the question. The easy bit is that most of the people who want to launch systemic payment systems using stablecoin or whatever want to be regulated. And if you want to use something at scale, remember they want to be a general purpose retail payment system, it's kind of inconceivable that they could do that in an advanced economy if we have rules about people carrying on regulated activities without permissions. And it gets some of the criminal sanctions, it's criminal. For most of them, the question is not whether they're going to be regulated, the question is what will the regulation say? And the CPMI IOSCO committee put out for consultation guidance 2 weeks ago on the regulation of systemic stablecoins, which tied us in knots because we normally regulate payment systems, and payment systems do not normally create the settlement asset. So we had a theological discussion reminiscent of the Middle Ages as to whether the principles that are standards for payment systems applied to the creation of the asset as well as the mechanism that moves the asset from one party to another. But we decided in the end that the security and robustness of the payment system depends on the security and robustness of the asset, and therefore if you're issuing your own asset, there are a number of expectations, and one of the expectations is repayment at par intraday, or by the end of day. So I don't know whether regulators will enforce those standards, but in the UK, I think we would enforce that as a standard. Can I just say that the hard part of your question is decentralized finance, where there are no intermediaries, or they say there are no intermediaries, and what we do now by regulating intermediaries, you can do this, you can't do that, these are your standards, they do by the code, the software. The actual code is if you like, the interface. And there's the possibility that somebody launches a payment system and there is no one to regulate. It's just code on the public blockchain, and there is nothing you can do to enforce standards. The standards are in the code, basically. And that, I think, is a big issue for regulators. Most of the people who claim to be, there's nothing here, there's just code, there is some platform, there is some organization, there is something there at the moment. But the possibility of somebody providing a payment system that is just public blockchain code, you download it, you use it, and there's no one to regulate is there. I don't think, though, that those are likely to become systemic payment systems used by households, unless there is a loss of confidence in money. But that's a big issue for us, and I don't have an answer to how you regulate it. I'm sorry, you wanted to raise it.
Imagine that I have an account in an Amazon or an Amazon-like platform. And at some point, they may decide that this is not unconditionally convertible into euros, and I can spend the balance into the goods that they offer, but maybe not outside.
Well, that's why Libra was so scary, because what you're mentioning is the value of money given by a large network. And actually, if I hold, let's say Libra was allowed to prosper, you hold this and you can expect that 1.5 billion people would accept it as a medium of exchange. Then you don't need convertibility in public money. You're absolutely right. And then, of course, the whole monetary sovereignty that Markus mentioned is gone. And there is a unit of account, which is a medium of exchange, which is cross-border. The monetary policy of the jurisdiction do not matter very much, and that was rightly seen as something which was totally destabilizing for the international monetary order as we know it. So what you're mentioning, of course, is that money can get value through network effects, and this is very important. This is very important, and so for the moment Libra has been dealt with, but it remains for the future certainly a possibility, and money can get value independently of any backing by the government through the extent of network effect. I do believe this is a possibility, and I do believe when we think about it, we should have that in mind. I think.
So I'll just say, I wouldn't ask you to read the guidelines, because I wouldn't ask anyone to do that, but it sets out, I'm talking about systemic payment systems, and it sets out some parameters, substitutability, scale, etc., for what is systemic. So we have in the UK the Bristol pound. You know, it's a pound that circulates in Bristol. For the local shop owners issue it, and it's kind of backed a little bit. We don't regulate it because it's small and voluntary. I don't know how big Amazon would have to be before we brought it into regulation. We didn't used to regulate Visa, but we brought them in 5 years ago. We've just brought MasterCard in. Yeah, our job is to work out where the perimeter is. But I am sure if we said to Amazon, you are now big enough, there's enough happening on your platform, you know, these are payments, we are now going to regulate that part of you as a payment system. I think they would, given that they need to operate within the rule of law generally. I think they'd argue and they complain to the politicians, but I don't think they would operate without permission. But it's a question of scale, and you know, at what point store cards, you know, at what point is a Sears card money? It's about how many people are using it. And we never worried about those things because they weren't that large, but Amazon's pretty large.
Yes,
Can I
Markus?
just make one small comment concerning convertibility? I think what Rafa was asking is, do you have a legal claim and you can go to court and convert it into some public money and then later on, or is it just like a peg and you can break the peg? And I think the legal ability to go to a court to have some claim then to convert it, so whether you can go to Amazon and sue Amazon essentially, makes a big difference. And once you have this convertibility, of course you have a more uniformity. And I think the ultimate aim is then to have less information sensitivity from a theoretical perspective. So, you know, everybody knows that's a common form, it's a common unit of account, and then there's less information asymmetry in the world, and that is just a more common way to deal with it.
I do not see more questions. Yes, I see one here.
I just wanted to contribute a small observation to elaborate on a point that John made before. A substantial amount of SME credit in the United Kingdom is provided by non-banks. It's not that this credit is provided without information, it's just that the information is provided by agencies like Experian. Probably the information that Experian now provides is much better than what the banks had 20 or 25 years ago, with very miserable records about creditors. So regarding decoupling, it's not as if that once banks don't manage the payment system, the information which is contained in payments is going to evaporate and vanish. It's just going to be managed by another specialized agency and perhaps do it quite well, at least in countries like the UK.
Who wants to start? Markus, would you start?
Yeah, so I don't know the specifics about the UK, but I can very well see that there will be some specialized agencies who manage the data much more efficiently than banks do at the moment. And if you have some part of the data openly available, there might be some IT firms which are, are very good in extracting information from payment data, combining it with other data, other transactions on a particular retail platform, and combine it. So when I went once to WeChat Bank in Shenzhen, and essentially what they told me, what really is crucial, what the spending patterns are to figure out the default probability, because the biggest item to default of a private consumer loans is getting a divorce, and having certain spending patterns on flowers and certain things might indicate your default probability. So there are a lot of detailed information which can be extracted from a huge amount of data, which might not necessarily be only payment data, but also combining with other data on retail behavior. And I can very well see that there can, there's new services popping up which have superior abilities to do that, and innovation will occur there, and there will be much better credit provision as a result of that.
Jean-Pierre? No? Anything else?
No, I just agree with what Markus says. I think there isn't that much switching by small businesses between banks. And when you ask them why they try to do the work, it's difficult for them to do that because their whole payment record is with one bank. I think Experian and others tell you a lot about credit defaults, loans that have been applied for, but they won't actually give you the transaction flow, the ingoings and outgoings from the institution. And I think increasingly as credit becomes automated, which is what you saw in China and the like, that sort of information is going to be necessary for banks and others making automated credit provisions. So whether banks collect the information and actively use it is a different question, but they certainly have access to basically all the financial transactions and the back history of a company. And if they've done, although for small companies now credit's basically commoditized, there isn't a local bank manager that knows your business anymore in the UK. You know, if you're below $1 million, you ring up a line and, you know, they treat it almost as a consumer loan. But there is, I think there's AI and other things on the horizon which with better information would automate credit and lead to better distribution of it.
I would like to raise a very simple question to the three of you, and you need to answer to me maybe in 30 seconds. So, what would be your opinion, the 3 to 4 main features of a CDBC to be accepted by the citizens? You said, John, if I remember correctly, that it is impossible to predict. But from the side of the citizens and consumers, what would be your preferred design? Markus, would you like to start?
Yes, I think let me just stress one feature. I think one feature which is very essential would be privacy. So do you have a certain amount of privacy for a certain amount of transactions? You know, if you pay some 10,000 euros or something, then not. But for small amounts of payments, there should be some key feature which is protecting privacy of the citizens.
Jean-Pierre?
Yeah, I was going to say the same thing, and I would add that it's not going to be easy with the general population to be credible on something which is on a ledger, because it has to be on a ledger, right? And ensure the people that it's going to be private. So the technical governance arrangement of CBDC will be extremely, extremely important in terms of ensuring its attractiveness.
Exactly, and also in terms of communication. John?
Yeah, so security and safety, privacy, convenience of use, and the most difficult one of all, which is where I think I come down on one side of Marcus's question, is we have to allow the private sector to integrate it into new digital offerings. Because if it's not about whether it can provide better payment services today, it's about it'll provide whether it can be integrated into apps and services that don't exist yet, that central banks can't see. Central banks are not great innovators, so we have to allow it to be used for innovation if it's to keep up with people's demand for it. Otherwise, it'll become a duckbill platypus, an evolutionary dead end.
Okay, thank you very much for this very insightful conversation. We've talked about from unbundling loan provisions from liquidity to CBDCs as legal tender without killing the smart contracts. Also how to regulate it and make it more attractive to citizens, to the need of unconditional convertibility of private money as today into public money, and of course the question of the quantitative restrictions, you are against it, or any kind of tiering in when pricing the CBDCs. So anyway, digitalization is here, tokenization of money is going in that direction. So again, thanks a lot for this very interesting panel, and enjoy the rest of the day and of course the dinner. See you later. Bye.
Bye, Marcus.
Bye, Marcus.
Goodbye, Marcus.
Thank you. Bye-bye.
Thank you.